On today's hot sheet, I'm discussing Zillow's housing market report, weekly mortgage applications, and commercial real estate debt. Today is Wednesday, January 17th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know which market you are tuning in live from. I'm here in my Naples, Florida studio today, and it's a pleasure to be with all of you as we dive into a 24-hour look back on everything housing. It's the only show on the internet that does it. Hit subscribe if you're enjoying the hot sheet. All right, let's take a look at Zillow's new updated market report. Before I even dive into this, Zillow has now revised their home price outlook for 2024. If you remember on the hot sheet, maybe just 100 days ago, maybe even 120 days ago, Zillow was very bullish on home prices for 2024. In fact, they were as high as 6.6%. Then we saw October happen. We saw an 8% handle on the 30-year fixed mortgage. And we saw Zillow, amongst many others, revise their home price projection down. Okay, Zillow went down all the way to 0% increase. Zillow was saying just last month, just within the last 30 days, that home price appreciation would be at 0% for 2024. Well, not anymore. Zillow, just like the report that we covered yesterday, has issued a new upward revision for its home price forecast. Zillow expects U.S. home prices to rise 3.5% between December 2023 and December 2024. Previously, again, at 0%. This is their official 2024 forecast because it covers the full 12-month calendar. So we'll give them a break on the flip-flopping the last few months. December to December, this is when you put your stake in the ground and say, this is where we're going. So Zillow now at plus 3.5%. So as consumers are asking, where are home prices going in 2024? The bandwagon is getting bigger that home prices are going to be going up. Zillow now joining Nick Shaw, who is the CEO of the company we covered yesterday, Home.LLC, who was one of the few that got it right last year. We also have really respected analysts, Ivy Zellman and others, saying small increment increases. So it's hard to find an analyst or a projection out there with a ton of credibility that has home prices falling. Certainly not anybody that has a sharp decline in home prices. But let's dig into the rest of the report here on Zillow, on where they think the 2024 housing market is going to go. That was just a quick update on pricing because we talk about pricing a lot. I thought it was important. And in December, according to Zillow, the U.S. Typical home value was $344,000. Monthly home value gains occurred in only 3 of the 50 largest metro areas in December, according to Zillow. Gains in New York, largest gains in New York, and that was 0.2%. Home values fell on a monthly basis in 46 major metro areas for the month of December, according to Zillow. And the largest drop was in Minneapolis at a negative 1.1%. New Orleans, Milwaukee, Buffalo, and San Antonio all had 1% drops as well, or 1.1%. Annual price gains were the highest in Hartford at 11.7%. We've talked a lot about the crunch of the Northeast inventory. Hartford in particular is down over 80% of inventory since the pandemic. That was a Lance Lambert stat on a recent Knowledge Brokers pod. And San Diego had an 8.4% annual increase, Milwaukee 7.9, Providence 7.9, Boston 7.5. So 3 of those 6 of the highest annual price gains were happening in the Northeast. But home values are up from a year ago in all levels in 43 of 50 largest metro areas. So December, we saw that decline, but that's typical. Okay, December is going to be typical to decline because of the seasonality of the market. Okay, if we take a look at the market overall on the right, the 344,000, you can see home values continue over a 12-month span here to be appreciating at quite a rate. Month over month is where you get some more of that volatility, and where we just experienced some volatility here in December 2023, not unlike most Decembers. Okay, if we click on December 2019, what I would consider a much more normal market, you can see that December 2019 had a similar story where you had home price values going down. In fact, you've got December 2023. If we go to there's January 2021 as the bottom there. You had a double dip in 2021, but if you go to last year, the bottom is 2022 for December as well. So December, the last 2 years are the bottom of any given year, and that's similar to a normal year like December 2019. Okay, let's take a look at some more of the data here from Zillow, and this is directly from our show notes. If you don't have access to our show notes, it means that you're not a BAMX member. To become a BAMX member, use code HOT to get 10% off. This 2023 December report highlights changes in the housing market. Despite the market remaining competitive, home buyers are benefiting from lower mortgage rates, and a recent survey indicates more homeowners are thinking about selling in the next few years. Remember, this was a big projection for 2024 from Zillow. They put out their top projections. We have an article on nowbam.com covering this. And one of the big projections was sellers are going to just come on to the market at a much higher rate than we've seen in the last 18, 24 months, because they're more comfortable where the rate is rather. And they're more comfortable with there's not going to be a big change. It's not coming back down to 4%. Like waiting out for that moment, it isn't going to happen. And so they're going to go ahead and make that life decision. Home buyers are experiencing relief right now. Rates have fallen from 23-year highs in October. That's that 8 handle I mentioned earlier. Obviously, they play a significant role in the affordability, especially for first-time home buyers. 21%. Here's the survey from Zillow. 21% of homeowners are considering selling their home within the next 3 years. That's up from 15%. Okay. That might be, a piece of information to send to buyers who are like, there'll never be more inventory. Hey, if we stay active now, if we stay in the game now, this spring could bring more inventory, could bring more opportunities to you. We did inventory yesterday, and it looks like by all measurements, we've hit the bottom on inventory. We've hit the bottom on new listings, according to Altos Research. And if you missed yesterday's hot sheet, definitely want to go check that out. It appears that we are heading in the right direction finally on inventory. It's going to take a while, obviously, to get to a 2019 normal level, but I will take the early momentum. So far, first 2 weeks of January have both been, more promising than the first 2 weeks of 2023 here. The first 2 weeks of 24 more promising than the first 2 weeks of 23. The survey also found that the share of homeowners selling was almost the same whether they had a mortgage rate above or below 5%. Okay, so that's that comfort level that we're talking about here, where it's like, okay, I'm just gonna have to make a move because my life depends on it. So regardless of where current mortgage rate is, the percentage was the same. It was very similar in both categories, above and below 5%. That means that these are just people who are moving because they have to move. They've got to get the bigger house, the smaller house. They want to tap out of the equity. The reasons that we know, diamonds, diapers, diplomas, all these different reasons that drive people to make a move, they're consistent in both camps, above and below 5%. The data shows more owners with low rates are warming to the idea of selling, while those with higher rates probably purchased their house fairly recently. Current mortgage rates look to be less of a determining factor when considering a sale. I think Lisa Chinati talked about this on the Knowledge Brokers podcast recently, where she's like, hey, we're digging into data like PropStream, for example. We have a link below where you can get an opportunity to sign up for PropStream data. So she's talking about taking data mining on PropStream and really reaching out to people who bought in 2020, early 2021. It's like, well, they just moved in a couple of years ago, 3 years ago. Well, why would you target them? And they've got the low rate. Because a lot of people made, to her point, a lot of people made really quick decisions during that time frame, and it might not be that right house for them. And now that we're further away from, the low rates, we're not getting back to that low of a standpoint. There could be some movement there. Zillow's kind of saying the same thing. If Haley, we'll have the link for PropStream obviously down below, but she'll put it into the comments if you want to check that out. That's great data to be able to say, okay, when did they buy? And you can even source, what's their interest rate. I think Zillow's making a good point there. You would think, well, I'll go target people that have a high interest rate, but that means they just bought, in the last year. It might actually be more beneficial to target sellers with a lower interest rate. Maybe going back to yesterday's data about empty nesters, maybe empty nester, lower mortgage rate, and somebody that wants to tap out of the equity, right? You would know your market as an agent better than I would on what numbers to hit there. Raw listings, Zillow saying the same thing here over as Altos Research, that we're on an upward trend here. We obviously need that to continue on new listing data. The last 2 weeks have been much promising over last year. Here's what Zillow says about total inventory. Number of listings active at any time during the month. So they're using a more of a okay, so they're using more of a NAR approach here. No, they're not. All right, they're good. In December, decreased 9.7% from the last month. There were 0.6. That's typical because of seasonality. There were 0.6 more listings active in December compared to last year. Inventory levels 36 lower than pre-pandemic. Inventory has marked slow but steady recovery from a 45.8 deficit in May. So that's the gap that we're talking about. 36% right now, lower than pre-pandemic, but the deficit in May was 45.8%. So it feels like the bottom is behind us on inventory. It's going to take some time. There's no question about that. But if we're getting better and better every single week, every single month, that's going to make for a much better, maybe even a more standardized spring, like we spoke about yesterday. Listings are going under contract about 50% faster than pre-pandemic norms. Okay, so if you look at 2018, 2019, listings going under contract about 50% faster. Benefit for sellers there. The share of homes that have sold above list price fell to 29.4% in December, down 2.4 percentage points from the previous month. The share of listings with a price cut just under 16% in December, the lowest since April 2022. Share of listings with a price cut was under 16% in December, the lowest since April 2022, according to Zillow. Price cuts in listings fell annually in 46 of 50 major markets. Great time, of course, to be a seller. There's a whole bunch of data packed in there, and we packed it all into you in bite-sized pieces so you can use it in a copy and paste format on whatever piece of information you'd like to, whether that's email, text, sending stuff out to your database, or even a video or show that you might be conducting for your database. We've got that all packed into our show notes, which we upload every single day for BAMX members. Another reason to get the most out of BAM by joining BAMX. Okay, let's talk about mortgage applications. Mortgage application volume increased 10.4% compared to the previous week. I'm loving this because we said last week it's really about next week. Last week we saw an increase in mortgage application, but that was coming off of a holiday week. It's like, of course, barely anybody's going to fill out a mortgage application during the holidays unless they've identified that house that they're going to buy. So mortgage application volume increasing 10.4% from the previous week is the number we wanted to see as we get into mid-January. That's the week ending in January 12th. Okay, adjustment was made to account for New Year's holiday and the results. The surge in demand is attributed to a drop in mortgage interest rates, as well as it's just coming off of a low number from the week before starting the year. The average contract interest rate decreased to 6.75%. That was the average contract rate, 6.75. Not bad, folks. I mean, for the only country in the world that offers a 30-year fix, getting it at a 30-year fixed at 6.75. When you put that into perspective, it's a fantastic deal. I know affordability is an issue when you match that rate with prices, but it's worse in some parts of the country, I can tell you, or some parts of the world, I can tell you that. Point increase from 0.61 to 0.62 for loans with 20% down. The declined marked the lowest rate in 3 weeks. Okay. Here's a comment here from Joel Kahn, the MBA's vice president and deputy chief economist. Mortgage rates declined across all loan types. Treasury yields moved lower last week. We've got an update on treasury yields today because it did not move lower today. This is on incoming inflation data, which helps support rise in mortgage applications. 30-year fixed rate decreased 6 basis points, 6.5. Compared to holiday adjusted week, both purchase and refinance applications were up. The increases were heavily driven due to the conventional market, although price activity is lagging year-ago levels. Refinance applications, talked about this last week, have improved from the recent low point and have been showing year-over-year gains, albeit at low levels. Year-over-year gains on refinances also is another indicator, like Zillow is saying, that people are more comfortable with these higher rates at this point. So good information to have as a real estate professional. Applications specifically to purchase a home rose by 9% for the week. So we've got 10.4 on total mortgage application increase. And of course, that 9% is still 20% lower than the same week a year ago. We'll see where we go into next week. I mean, right now we're looking at a 30-year fixed going into the end of the week that could pop a little bit. I'm definitely not rooting for that. But it could pop just a little bit, which obviously could impact the applications data. If we take a look, I'll just jump here before I get into this commercial debt. We usually do the 10-year at the end of the show, but I can't hold back. I can't hold the bad information back from you guys. It's 4.111. It's popped up. This is off of a surge in retail sales. You see here the CNBC headline this morning. The biggest headline was 10-year Treasury yield surges to a 5-week high above 4.11 after strong December retail sales, which were released this morning. So this will impact those mortgage rates that we just talked about. December retail sales indicated strong consumer demand at holidays. Retail sales increased 0.6% for the month. That was above economist estimates of 0.4%. Excluding autos sales rose 0.4%, which also topped a 0.2 estimate. So anytime we have data like this that exceeds expectations by this much, if an estimate was 0.4% and it's 0.6%, well, that's 33% higher than estimate. It's a big gap there. Anytime we see that, the market reacts negatively because that's another piece of data that could impact inflation. Okay, so they also jumped after comments from Federal Reserve Governor Christopher Waller, who suggested that while the central bank will likely cut rates this year, it may take its time. Okay, so sending out a signal here that maybe not coming as soon as the market would like. So retail sales data, along with some commentary from the Fed to slow down, is impacting that 10-year here in the short time, at a time when we want to get this early inning spring market, this pre-game spring market going a little bit. We may see a little a pop right now on the 30-year as we get more data down the road in the coming weeks. And if it's positive on inflation, if we get an indication that a rate could be coming at the end of the first rate cut, could be coming at the end of the first quarter, you could see that pop down. I know everybody's talking about our rate's going to be in the low 6s or the high 5s. I've my average for the year is just above 6.375, like a 6.4 for the average. So I believe there's going to be some more volatility. This is a sign that, hey, we'll probably experience a little bit of that volatility even today. Nobody's going to probably experience volatility more than commercial real estate debt holders and those who are on the hook for that debt. Wall Street Journal reports the bill is coming due on a record amount of commercial real estate debt. Of course, we've talked about this number. More than 2.2 trillion in debt is maturing before 2008, and much of that will have to be refinanced at higher rates. Okay, so in 2023, 541 billion in debt backed by office buildings, hotels, apartments, and other types of commercial real estate came due. It's the highest amount ever for a single year, according to data from TREP. Commercial debt maturities are expected to continue rising, with more than 2.2 trillion by the end of 2027. Most of these loans so far have been repaid or extended. Okay, so a lot of times they're just going to extend a loan and see what happens, right? Both sides are like, okay, let's extend this out. I understand that you can't, get a new deal. Let's extend the loan out and see what happens. In 2022, 2023, many owners were able to exercise 1 or 2 year extensions built into their original loans. Okay, but now those extensions are going to burn off. And listen, the bank can't extend past, if right now the rates are where they can't just be like, well, I'll just decide to give you, 3.5%. It doesn't work that way. The extensions were built in, they're now gone. And they've got an issue there. Borrowers, this is Gwen Roosh from DBRS Morningstar. Borrowers have been simply unwilling to accept reality. This is big commercial borrowers. But reality has to come due at some point. Unlike home mortgages, whose principal is paid off over time, most commercial mortgages are interest only. That means when the debt matures, the borrower has to refinance or pay off the principal. The problem with paying off the principal is these values on commercial real estate have come down, specifically on office buildings. The peak pricing from apartments has cooled down. Okay, so if you're going to go and sell that to just pay the debt off and you've been on interest only the entire time, you have an asset that's gone down in value. I mean, how many times last year did we show the values in San Francisco, in New York, and how they've come down in office buildings? If there's anything that's going to disrupt a soft landing in the economy this year, it would certainly be office building real estate. While office building owners have been especially hard hit from remote and hybrid work, this is Wall Street Journal again, the damage to the commercial real estate sector is widespread. Vacancy rates are increasing in some multifamily markets. This is what I'm talking about, Jay Powell. Vacancies are increasing. Rent is going down. Get your head out of the sand and let's get a new model for the CPI. Making it harder for many of those landlords to raise rents or make payments even on the floating rate debt. Industrial space, long the darling of Wall Street for its use as e-commerce hubs, is also showing signs of weakness. Okay, this is, if I'm the Fed, this is one of the reasons why I'd be so locked in on getting these rates down. If you get a commercial real estate crisis on your hands, it's not just going to impact those investors who invested in those office buildings. It's going to impact a lot of banks. A lot of regional banks have commercial loans as their biggest holdings. So the sooner you can get these rates down, the sooner these parties can come up with some type of a refinance. There's not a market for office buildings. Okay, so they've got to come up with some type of a refinance so that you don't have a commercial building bloodbath on your hands, because that's absolutely what would happen if the rates stay high. The consumer has already really shown us that. I mean, look at December retail sales that we just went over. The numbers are astronomical. The consumer isn't really feeling inflation. I mean, I know some are. I shouldn't say they're not really feeling inflation, but it's come down significantly and the economy remains robust. The economy remains very strong. So for commercial real estate, the punchline is rate cuts can't come fast enough. The sooner we get the rate cuts, the sooner we could refinance some of those deals and get to a more stable place. I don't know if they don't do rate cuts soon, then it's almost like Fed. Do you want a commercial real estate crisis potentially worse than the residential crisis we had during the mortgage crisis? Potentially worse. I mean, it would be big. It'd be catastrophic because it would take down a lot of regional banks along with it. Here are some of the refinancing challenges straight out of the show notes. Again, we talked about borrowers having to pay off. Commercial real estate sectors also have these rising vacancy rates. Fitch Ratings projects an increase in delinquency rates for commercial mortgage loans converted to securities, with retail, hotel, and office delinquencies expected to rise. And here's delinquency rates of commercial mortgage loans. 2.25% in 23, 4.5% for this year projected, 4.9% for 25. Financial regulators worried that commercial property losses could have broader implications for the financial system. Yes, that's exactly what I'm talking about. There's no way you can avoid that if you keep these rates up higher, which means we'd have to do what's more expensive, getting rates lower or having to do a bailout for a whole number of banks and these commercial buildings. I think let's get the rates lower sooner than later and see what happens. All right, we told you 10-year. I'll take another peek at it. Can we get this thing to tick down? Nope. Every time I look today, it goes up. Every time I look. So I'm going to stop looking for the rest of the day is basically what I'm going to do. We've got 6.77 yesterday on the 30-year fixed reading. So that popped up from Friday after the 3-day weekend. I'd expect this to get up again, unfortunately, here today. I'd expect the 30-year fix to pop a little bit based off of this 10-year. We shall see. We'll be back, obviously, tomorrow. There's one place that you want to be on February 7th, of course, and that's the BAM Pro Bowl. Okay, this is a free virtual event headlined by Ryan Serhant, Neil Dingra, David Childers, Jason Pantana, Gary Gold, Danielle Garofalo, Marie Lee, Jimmy Mackin, myself. We're going to have the Broke Agents, as well as a opening anthem by Amanda Bradford, a halftime show, and a post-game show. You do not want to miss the BAM Pro Bowl. Grab your seat for the free virtual event down below. Obviously, get the most out of BAM by joining BAMX. Use code HOT for that to get 10% off. And I will see you all back here tomorrow, 9:30 on the East, 6:30 on the West. Until then, toodaloo.